Today, I'm going to talk about a company called the Toro Company, give a little business overview, talk about the financials and what the market's value at today.
All right. Well, that sounds interesting. So I know nothing about Toro. So tell me, what do they do? Give me a little business overview of the company.
So, they're basically a tools company. You can think of lawnmowers, snow management tools, and even like golf course equipment. So, if we look at their revenue split, they kind of have a dual split. So, part of the revenues go professional, part residential, and then you have that other. So, basically, the idea is you see some other companies do this too, where you build the brand in the consumer side, and then that kind of helps you sell into the professional side sometimes when you have that brand recognition. So they have a lot of different growth drivers going for them, from 5G rollout to infrastructure to even golf, something as simple as golf. They have pretty good revenues from that as well. So they can be kind of an exciting company in that regard. But in other regards, they're a little bit boring because there's nothing new or flashy about
Mhm.
the company. One of the things they do focus on now is this move away from gas powered lawnmowers, as an example, towards battery powered.
Hmm.
And in the latest earnings call, the CEO was talking about how he got the chance to get his hands on one of their new battery powered gardening tools. And he basically said, it's a zero compromise. So you're going to get the same kind of performance out of one that's battery powered versus gasoline. But he mentioned one of the benefits of being able to get up really early in the morning, turning that thing on and not waking up your neighbors. That could,
Yeah.
that could be a big benefit, especially if you're a tired dad and the only time you get is
Yeah.
6 o'clock in the morning to go do your lawn maintenance. That could really be helpful.
Yeah, absolutely. I think I read recently that I think the state of California was outlawing the use of gas powered leaf blowers. Yeah, that's exactly what you're talking about. Those things are so loud. It's ridiculous.
They did talk about the whole California thing, so they're very aware of these kind of issues and they're kind of trying to move past them. And part of that's investing in new technology like that.
I think back in the day, I think I did own a Toro snowblower and I used that a lot, unfortunately. So,
Unfortunately.
yeah.
I guess it's better than using like a griffin shovel or something, right?
Yeah, yeah, true. Yeah, very true. Much easier on the backs. All right, so tell us a little bit about the financials. What do they got going under the hood?
Sure. So stock price has kind of struggled as of late, but longer term they've done pretty well. So one of the things I like to look at is gross margin. Gross margins have come down over the last 3-4 years, so that's something to look at compared to their peers. ROIC, they're pretty high return on capital company. Last 10 years, they've had a median of 25%. So that's pretty good. Revenue over the last 10 years, if you look at that, it's a 7.7% CAGR, but they have these revenue growth in chunks. So like 2015, 10%, 2019, almost 20%, 2020, huge boost, 17%. But how much of that is because of COVID? It's hard to
Yeah,
say.
hard to
So
say.
they'll have like periods of low growth followed by periods of super high growth. And that's kind of the story behind their financials, big picture.
Yeah. Okay. Well, let's talk about what's the market value in the company at.
Yeah, most definitely. So I'm going to show, this was a spreadsheet I made using our valuation tool that we use. It's called the Little Package Evaluation. This is the free cash flow of the firm DCF model. So you can see it's very simple. You have these 4 inputs here, 2 inputs here, a couple inputs here, and 3 inputs there. And that gives you an estimate of the fair value. So today it's trading at 99.50. The model here came up with a 126.67, implies that it's possibly undervalued at the time. But, I highlighted these 2 inputs because I think if you change these inputs, they kind of really change the value of the company and what comes back. So, on the one hand, if you look at their WACC, which is their cost of capital, most websites have them somewhere around 7%. You'll see most companies kind of around this kind of a WACC right now. And it's really because of the low interest rates. But if I were to push this up to something like 9% instead of 7, you can see the fair value comes down to more in line where the company is, where the stock's trading today. It really is a pretty cyclical company. So you would wonder about if that really makes it deserve a higher cost of capital, because if the free cash flow is so up and down and lumpy, it's hard to say that, okay, I think in 5 or 10 years we'll have this much free cash. And so that's kind of the idea of why you would maybe use a higher discount rate, which would suggests that maybe it's not as undervalued as initially seems. The other thing is the revenue. If we were to bring this back down to 2020 numbers, because obviously you had a huge boost in 2021, again, because it seemed like everybody wanted to do gardening for the pandemic. You see this come down quite a bit where, we went from 126 to 115. And so again, it really comes down to where you think how temporary and how permanent are some of these values for the company, some of their recent financials, and kind of how cyclical they are. That can have a big bearing on where the intrinsic value is. So in general, it's maybe fairly valued today, maybe slightly undervalued. That's just on the free cash flow of the firm. And obviously you'd want to do deeper. I didn't get a chance to do a free cash flow of the equity yet. That's next on my list. But as far as the free cash flow of the firm, it seems fairly valued.
I would probably agree with that just by looking at the numbers that you are projecting and the idea that the discount rate will probably go up as well, especially when you compare that to revenues seem to be a little elevated at the moment. And I bet if you normalize those over the last 5 years and throw that in there, it would probably come back closer to value.
Yeah, agree with that too.
Yeah, good assessment. I like that. That was an interesting overview of Toro.
Thank you.
You're welcome.